Most investors believe they lose money because of bad timing, unlucky trades, or market crashes. In reality, the biggest reason is much simpler. It is a repeated behavioral mistake. This mistake is not obvious at first, but over time it quietly destroys wealth. The problem is not what people invest in, but how they react. Small emotional decisions, repeated again and again, slowly prevent growth and lead to losses instead of long-term financial success. The core mistake is emotional investing. When markets rise, investors feel confident and rush to buy, often at high prices. When markets fall, fear takes over, and they sell to avoid further losses. This creates a destructive pattern of buying high and selling low. Instead of following a plan, they react to feelings. Over time, this behavior guarantees poor results, even if the chosen investments are fundamentally strong and capable of long-term growth. Another part of the mistake is chasing trends. Investors often wait until an opportunity becomes popular before taking action. By the time they invest, prices are already high and the real growth has already happened. When the trend fades, they are left holding assets that decline in value. This cycle repeats constantly, keeping investors stuck. Instead of building wealth, they follow hype and end up entering too late and exiting too late as well. Lack of consistency is another major issue. Many investors start with motivation and discipline, but stop investing when markets become uncertain or when results feel slow. This inconsistency breaks the compounding process. Wealth is built through steady, repeated actions over time. Without consistency, even good strategies fail. Starting and stopping repeatedly prevents momentum from building, making it almost impossible to achieve meaningful long-term growth. Impatience destroys more portfolios than bad investments. Many people expect fast results and become frustrated when they don't see immediate progress. They begin switching strategies, chasing new ideas, and abandoning plans too early. Real wealth takes time to develop. Compounding works slowly at first, then accelerates. Those who quit early never reach the stage where growth becomes powerful, and they stay stuck in a cycle of restarting over and over again. Trying to time the market is another costly mistake. Investors believe they can predict the best moment to buy and sell. In reality, even professionals struggle to do this consistently. Waiting for the perfect opportunity often leads to doing nothing at all. While they wait, they miss valuable time in the market. Long-term investing rewards participation, not prediction. Being consistently invested produces better results than trying to guess short-term movements. Overconfidence is another reason investors lose money. After a few successful trades, people start believing they fully understand the market. They take bigger risks, invest larger amounts, and ignore proper analysis. This false confidence leads to poor decisions and unexpected losses. Markets are unpredictable, and assuming control over them is dangerous. Smart investors remain cautious, while overconfident ones eventually face setbacks that erase their previous gains. Short-term thinking prevents long-term success. Many investors focus on daily or weekly price changes instead of overall growth. They react to small movements, making unnecessary decisions that disrupt their strategy. Real wealth is built over years, not days. By focusing too much on short-term results, investors lose sight of the bigger picture and reduce their chances of achieving meaningful financial progress. Another mistake is poor diversification. Putting too much money into a single asset increases risk significantly. If that investment performs poorly, the entire portfolio suffers. Diversification spreads risk across different assets, reducing the impact of any single loss. Investors who ignore this principle expose themselves to unnecessary danger, making their financial outcomes unstable and unpredictable over time. Frequent trading is a hidden problem. Many investors believe that constant activity leads to better results. In reality, frequent buying and selling increases transaction costs and often leads to poor timing decisions. Each trade reduces overall returns. Long-term investors who hold quality assets tend to outperform those who trade excessively, simply because they avoid unnecessary costs and mistakes. Ignoring fees is another costly mistake. Investment fees may seem small at first, but over time they accumulate and significantly reduce returns. High management fees, commissions, and hidden costs quietly eat into profits. Investors who pay attention to costs keep more of their money invested and compounding. Over decades, even small fee differences can create a large gap in total wealth. Lack of financial education leads to poor decisions. Many investors do not fully understand how markets work, how compounding functions, or how risk should be managed. Without this knowledge, they rely on emotions or random advice. Education builds confidence and improves decision-making. Investors who take time to learn are more likely to follow a consistent strategy and avoid costly mistakes. Fear during market declines causes many investors to sell at the worst possible time. When prices drop, panic takes over, and protecting remaining money becomes the priority. However, selling during downturns locks in losses and removes the chance to benefit from recovery. Markets historically recover over time, but only those who stay invested experience that growth. Acting on fear interrupts compounding and turns temporary declines into permanent financial damage. Greed during market highs is just as dangerous as fear during declines. When prices rise quickly, investors feel excitement and rush to buy without proper analysis. They assume growth will continue indefinitely. This often leads to buying overvalued assets at peak prices. When the market corrects, those investments fall, causing losses. Greed pushes investors into poor decisions, replacing discipline with emotion and reducing long-term returns. Inconsistent investing prevents compounding from working effectively. Some investors contribute only when they feel confident or when markets are rising. During uncertain periods, they stop investing completely. This breaks momentum and reduces long-term growth. Consistent investing, regardless of market conditions, allows investors to benefit from both highs and lows, building a stronger and more stable portfolio over time. Failing to reinvest profits significantly slows wealth growth. When investors receive dividends, interest, or gains, they often spend the money instead of reinvesting it. This interrupts the compounding process. Reinvesting returns allows money to generate additional returns, creating exponential growth over time. Without reinvestment, progress becomes linear instead of exponential, limiting long-term financial success. Waiting too long to start investing reduces potential wealth dramatically. Many people delay investing because they believe they need more money or better conditions. However, time is the most powerful factor in compounding. Starting early, even with small amounts, allows investments to grow over decades. Delaying even a few years can significantly reduce final results, making it harder to achieve financial goals. Lifestyle inflation quietly prevents wealth accumulation. As income increases, spending often increases as well. Instead of investing additional earnings, many people upgrade their lifestyle. While this may provide short-term satisfaction, it limits long-term growth. Investors who control spending and direct extra income toward investments build wealth faster and create financial security over time. Comparing yourself to other investors often leads to poor decisions. Seeing others make fast profits can create pressure to act quickly or take unnecessary risks. Every investor has a different timeline, strategy, and level of experience. Focusing on others instead of your own plan leads to emotional decisions and inconsistent behavior. Staying disciplined and committed to your personal goals is far more effective than chasing someone else's results. Following the crowd is a common mistake that leads to losses. When many people invest in the same opportunity, prices are often already inflated. Investors who enter late are exposed to higher risk and lower potential returns. Successful investing requires independent thinking and a clear strategy. Relying on popular opinion instead of analysis often results in buying at the top and selling at the bottom. Lack of clear financial goals creates confusion in investing decisions. Without a defined objective, it becomes difficult to stay consistent or measure progress. Investors may switch strategies frequently or act impulsively. Clear goals provide direction and purpose, helping investors stay focused during both good and bad market conditions, and improving long-term outcomes. Avoiding all risk is just as harmful as taking too much risk. Keeping money in low-return assets may feel safe, but it prevents growth. Inflation gradually reduces purchasing power, meaning money loses value over time. Balanced risk, through diversified investments, is necessary to achieve meaningful returns and long-term financial progress. Overcomplicating investment strategies often leads to mistakes. Many investors believe complex methods produce better results, but complexity increases confusion and inconsistency. Simple strategies are easier to follow and maintain. Consistency is more important than complexity, and simple plans often outperform complicated ones over the long term. Failing to review investments periodically can cause problems over time. Portfolios may become unbalanced or misaligned with goals. Regular reviews allow investors to make small adjustments, manage risk, and stay on track. Without review, mistakes can go unnoticed and grow into larger issues that affect long-term results. Ignoring inflation is a silent mistake that reduces real wealth over time. Even if your money appears to grow, inflation can erode its purchasing power. If investments do not outpace inflation, you are effectively losing money. Many investors focus only on nominal returns and forget about real value. Understanding inflation is essential for building long-term wealth. Relying on luck instead of strategy leads to inconsistent outcomes. Some investors expect one successful investment to change everything. While occasional gains can happen, sustainable wealth requires discipline and planning. Consistent investing, diversification, and long-term thinking are far more reliable than hoping for a single lucky opportunity. Stopping investments during market downturns is a major mistake. When markets fall, many investors pause contributions or withdraw money. However, downturns often provide the best opportunities to buy assets at lower prices. Continuing to invest during these periods strengthens long-term results and improves overall returns. Emotional reactions during crises often cause the biggest losses. Economic uncertainty, market crashes, or negative news can trigger panic. Investors who act impulsively during these times usually sell at a loss. Staying calm and following a plan is critical to protecting long-term growth and avoiding unnecessary mistakes. Lack of patience prevents compounding from reaching its full potential. Many investors give up too early, before their investments have time to grow significantly. Compounding takes time to accelerate, and those who remain consistent benefit the most. Impatience leads to missed opportunities and weaker results. Failing to increase investments as income grows slows wealth accumulation. When earnings rise, many people increase spending instead of investing more. Allocating a portion of income increases toward investments accelerates growth and strengthens long-term financial outcomes. Not automating investments leads to inconsistency. When investing depends on mood, timing, or memory, contributions are often skipped. Automation removes this problem by making investing a routine process. Regular automatic deposits ensure that money is consistently put to work, helping build wealth without relying on constant decision-making. Spending unexpected income instead of investing it limits long-term growth. Bonuses, gifts, or extra earnings are often used for short-term. However, directing these funds into investments can significantly boost compounding. Using unexpected income wisely creates a powerful advantage over time. Ignoring risk management exposes investors to unnecessary losses. Taking on too much risk can lead to large setbacks, while too little risk prevents growth. A balanced approach helps protect capital, while still allowing investments to grow steadily over time. Constantly changing strategies prevents long-term success. Many investors jump from one idea to another, never allowing any strategy to fully develop. This lack of consistency disrupts compounding and leads to poor results. Staying committed to a well-thought-out plan is essential. Focusing too much on short-term results creates stress and poor decision-making. Daily price movements are unpredictable and often irrelevant to long-term growth. Investors who react to short-term changes tend to make unnecessary adjustments that reduce returns. Avoiding learning leads to repeated mistakes. Investors who do not take time to understand markets and financial principles often repeat the same errors. Continuous learning improves decision-making and strengthens long-term investing success. Not having a clear system creates inconsistency in investing. Without a defined process, decisions become random and influenced by emotions. A structured system helps investors stay disciplined, make consistent contributions, and avoid impulsive actions that lead to losses. Overreacting to news is a common mistake. Headlines are designed to create urgency and emotion, not long-term value. Investors who react to every piece of news often make unnecessary changes that hurt performance. Staying focused on strategy is more important. Failing to stick to a plan reduces long-term effectiveness. Even the best strategy will not work if it is not followed consistently. Investors who constantly adjust their approach based on emotions never allow their plan to succeed. Lack of confidence prevents action. Some investors hesitate too much, waiting for perfect certainty. This leads to missed opportunities and lost time. Taking action with a reasonable plan is better than waiting indefinitely. Not understanding compounding limits wealth potential. Many underestimate how powerful reinvested returns can become over time. Compounding requires patience, but it is one of the strongest forces in building wealth. Ignoring small habits reduces long-term results. Small decisions repeated daily or monthly have a significant impact. Consistent saving and investing habits create a strong financial foundation over time. Seeking shortcuts often leads to risky behavior. Quick gains may seem attractive, but they usually come with higher risk. Sustainable wealth is built through steady and disciplined investing, not shortcuts. Quitting too early stops progress completely. Many investors abandon their strategy before seeing real results. The early stages may feel slow, but persistence is what allows growth to accelerate later. Not adapting gradually to changes creates instability. While consistency is important, small adjustments help maintain balance. Investors should refine their approach without abandoning their strategy entirely. Expecting quick results leads to disappointment. Investing is a long-term process. Those who expect immediate success often become discouraged and stop, missing future growth. The real difference between successful and unsuccessful investors is behavior. Discipline, patience, and consistency create results, while emotional decisions destroy them over time. In the end, most investors lose money because of one simple mistake: ignoring discipline. Following a clear plan, staying consistent, and controlling emotions are what build real wealth over time.